The gold market has entered a phase where patience itself has become the rarest commodity, and every passing session without a decisive move raises the same unsettling question that traders whisper but rarely voice aloud. Can a powerful upward trend simply fade away if the supporting narrative grows too quiet for too long? Dips, corrections, and temporary pullbacks have long served as welcome opportunities for disciplined participants to improve their average entry points, provided those pauses remain brief and the underlying momentum eventually reasserts itself. Yet the current pause has begun to test that assumption, stretching further than many anticipated and forcing a closer examination of whether the recent softness still qualifies as a healthy reset or has started to harden into something more structural. Most observers instinctively reject the notion that a sustained advance can simply expire. History offers numerous examples of precious metals grinding higher through periods of skepticism before ultimately rewarding those who held firm. Still, the present environment may be different because gold no longer appears to require merely one isolated catalyst. It requires that catalyst to arrive before collective attention drifts elsewhere, and the market recalibrates its expectations around a new, lower baseline. The longer prices remain range-bound near recent levels, the deeper the psychological trench becomes. Should monetary authorities maintain a restrictive stance, should price pressures prove sticky, and should anticipations of easier policy continue sliding further into the future, the current adjustment stops resembling a fleeting opportunity and begins resembling a lasting revaluation. The central issue, therefore, is not whether gold retains the capacity to advance. It is whether that advance can materialize while the broader marketplace still regards it as probable. Before exploring the forces at work, a brief note about reliable access to physical metal. For those seeking both acquisition and liquidation options in the current climate, Summit Metals continues to provide a straightforward avenue, including loyalty incentives on purchases and assistance, when the time comes to convert holdings back into currency. Their platform remains available at the familiar address for anyone evaluating practical next steps, turning to recent developments that, on paper, should have provided at least modest support. Several notable releases arrived in close succession. Policymakers on both sides of the Atlantic elected to leave benchmark rates untouched. Economic activity in the United States moderated more noticeably than consensus forecasts had projected, even as weekly unemployment filings remained comfortably beneath the 200,000 threshold. Under ordinary circumstances, that combination of unchanged policy, softer growth, and contained labor market stress would have encouraged a constructive response in the metal. Instead, price action stayed muted. The absence of reaction does not stem from a shortage of theoretically supportive headlines. Rather, the market has raised its threshold for what constitutes sufficient encouragement. With each additional week of waiting, the probability that more decisive news will eventually appears paradoxically to diminish in the eyes of many participants. A meaningful repricing episode that once felt temporary can, under those conditions, start to feel durable. Evidence of shifting sentiment surfaces clearly in the latest comprehensive demand statistics released by the World Gold Council. Aggregate demand held roughly steady across the most recent quarter. Yet that headline stability masks a pronounced internal realignment. Investment-related purchases contracted by more than half. Demand for bars and coins declined by roughly 1/3, returning closer to longer-term averages after an earlier surge. Exchange-traded products experienced an even sharper contraction, falling from 175 tons to only 62. Further detail reveals 45 tons of net outflows from those vehicles during the second quarter alone. The flat overall total, therefore, conceals the fact that one particular channel has shouldered a disproportionate share of recent support. Central bank acquisitions, by contrast, expanded 62% compared with the same period a year earlier. That divergence prompts a natural inquiry. If official institutions continue accumulating aggressively, why have private investors chosen the opposite path? The answer lies in differing time horizons. Private participants tend to focus on the next several weeks or months, scanning for near-term catalysts that might lift prices quickly. Official reserve managers operate on multi-year frameworks. Their purchases reflect a desire to reduce reliance on purely financial claims and to increase holdings of a tangible, non-liability asset. Consequently, they have maintained steady buying even while many others pause or reduce exposure following the substantial upward revaluation already achieved. One legitimate concern arises from that concentration of demand. If official institutions have supplied the primary floor beneath the market, any material deceleration in their purchases could remove the single largest source of support and precipitate a more pronounced adjustment. Yet available survey evidence points in the opposite direction. The most recent central bank questionnaire conducted by the World Gold Council indicates that 89% of respondents anticipate further growth in global official gold reserves. Nearly half of the participants expect their own institutions to add still more metal. Both realized purchases and stated future intentions therefore align. The persistence of official demand supplies a structural underpinning that private investment flows have temporarily vacated. That observation leads directly to the puzzle of valuation. Despite the robust official buying, prices have hovered near the $4,000 region rather than pressing higher. The market continues to await a visible shift in the policy trajectory. 8 months have elapsed without such a pivot. Attention now focuses on the mid-September policy gathering, with 2 additional inflation readings scheduled to appear before that date. Until those reports arrive and are digested, little incentive exists for aggressive repositioning. Should the forthcoming data fail to improve sufficiently, or worse, deteriorate, authorities are unlikely to alter course, and the prospective window for a near-term recovery narrows further. Each successive delay allows the marketplace additional time to acclimate to the current price neighborhood, reducing the urgency that once accompanied every modest pullback. This risk is unusual. It is the risk that an extended pause ceases to be regarded as temporary, and that expectations of recovery gradually erode. Nothing in the present evidence declares the longer-term upward structure finished. That conclusion would require a more decisive break in both official and private demand, neither of which has occurred. At the same time, it would be imprudent to assume that any recovery must commence precisely in September. Market implied probabilities currently assign a substantial likelihood to further restriction at the mid-month gathering. Several voting members have already signaled preference for tighter settings, and they will require clearer evidence of cooling price pressures before reconsidering. Between the present and that meeting lie two successive consumer price releases together with ongoing observation of energy cost trends that could reaccelerate inflation. Two conditions, therefore, stand out as necessary. First, the probability of additional tightening must begin to recede, an outcome that becomes far more plausible if the next two inflation prints demonstrate meaningful progress. Second, prices must demonstrate an ability to sustain levels above 4,100. A brief excursion through that threshold, followed by an immediate retreat, carries limited informational content, particularly during the traditionally quieter late summer period of reduced participation. Meaningful confirmation of renewed momentum would more likely appear only once the metal establishes a foothold inside the 4,300 to 4,600 corridor. Analyst projections that envision substantially higher levels in the following calendar year rest on the assumption that these near-term hurdles are cleared relatively promptly. The calendar, therefore, presents a compressed interval of opportunity. Should the approaching inflation data begin to lower the odds of further restriction, the metal would possess a realistic chance of reasserting upward pressure in short order. Should those reports instead reinforce the case for prolonged restraint, the market risks remaining confined within its recent range for a longer stretch. That is why the two forthcoming consumer price indexes may prove the most consequential releases of the entire summer season for participants in this market. Beyond the immediate data sequence, broader structural considerations continue to favor the metal over multi-year horizons. Fiscal trajectories in major economies remain expansionary. Geopolitical frictions show little sign of permanent resolution. The relative scarcity of above-ground inventories compared with the volume of financial claims continues to underpin longer-term valuation arguments. Central bank diversification away from concentrated reserve currencies supplies an ongoing bid that private investment flows may eventually rejoin once near-term policy clarity improves. Silver, meanwhile, retains its dual character as both a monetary and an industrial metal, with demand from energy transition applications providing a separate secular support that can amplify any recovery in the broader precious metals complex. Market psychology itself often follows a predictable arc during extended consolidations. Initial pullbacks are greeted as buying opportunities. Subsequent failure to rebound quickly breeds caution. Prolonged sideways movement eventually produces resignation among those whose time horizons are measured in weeks rather than years. The risk is that a sufficient number of participants migrate from the first camp into the third before the fundamental backdrop shifts. Official institutions operating with longer planning cycles appear less susceptible to that progression. Their continued accumulation may ultimately serve as the bridge that carries the market through the current interval of private hesitation. Liquidity conditions also warrant attention. Late summer sessions frequently exhibit thinner order books, which can exaggerate both rallies and declines. A modest positive catalyst arriving against a backdrop of reduced participation can produce an outsized initial response that later requires confirmation once normal volumes return. Conversely, the absence of catalysts during quiet periods can allow drift lower that feels more significant than the underlying flows justify. Participants monitoring the market would therefore do well to distinguish between genuine shifts in conviction and the mechanical effects of seasonal liquidity. Currency dynamics supply another layer. Periods of relative strength in the primary reserve currency have historically exerted pressure on metals priced in that unit. Any sustained moderation in that strength, whether prompted by growth differentials or policy divergence, would remove one headwind. Energy markets likewise remain relevant. Sustained increases in petroleum prices can feed into broader inflation measures and complicate the path toward easier monetary settings. Monitoring those cross currents remains essential, even while the primary focus stays on the official inflation series. Inventory data from major exchange warehouses and physical market premiums offer additional real-time signals. Persistent drawdowns or elevated physical premiums can indicate underlying tightness that is not yet fully reflected in futures pricing. Conversely, rising inventories and disappearing premiums can signal temporary abundance. At present, the picture remains mixed, consistent with a market that has not yet resolved its near-term directional uncertainty. Looking further ahead, demographic and technological trends continue to shape long-term demand. Expanding middle classes in several large emerging economies historically increase appetite for physical holdings as stores of value. Simultaneously, industrial applications for both gold and silver in electronics, medical devices, and renewable energy systems provide a floor that pure investment demand alone cannot supply. These secular forces do not dictate month-to-month price action, yet they reduce the probability that any extended consolidation will reverse to a multi-year decline. Risk management remains paramount for anyone with exposure. Position sizing calibrated to personal tolerance, diversification across forms of ownership, and a clear understanding of the distinction between short-term trading and long-term allocation all help navigate intervals of uncertainty. The current environment rewards those who distinguish between noise generated by delayed policy signals and the deeper structural supports that have not disappeared. In summary, the metal finds itself at an inflection where time itself has become a critical variable. Official demand remains robust and forward-looking surveys reinforce the likelihood of further accumulation. Private investment flows have stepped back, waiting for clearer evidence that monetary conditions will eventually ease. Two inflation reports stand between the present and the next major policy gathering. The outcome of those reports will largely determine whether the market rekindles expectations of an advance or settles more comfortably into the current valuation range. Neither outcome would invalidate the longer-term case built on fiscal realities, geopolitical complexity, and official diversification. They would, however, shape the path and the patience required to realize that case. Participants are invited to share their own assessments. Some may have concluded that the recent advance has run its course for the time being. Others may align more closely with the multi-year perspective evident in official reserve management. Either viewpoint contributes to a richer collective understanding. Engagement through comments, together with continued attention to subsequent developments, helps keep the conversation grounded in evolving evidence rather than fixed narratives. Those who found value in the preceding analysis are encouraged to register their interest so that future updates reach them promptly. Appreciation is extended to everyone who has remained through to the conclusion. The time invested is never taken for granted.